Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And I can't believe it's already been 3 years that the OG of all-in-one leverage covered call ETFs has been out yet. Of course, I'm talking about HDIV, or the Hamilton Enhanced Multi-Sector Covered Call ETF. Absolutely incredible, 3 years celebrating, and boy, what a journey it had, right? So in today's video, what I want to do is review the objectives and the composition of this ETF. We're also going to look through the distribution history, the yield as well of this fund. We're going to look at the history in terms of the holdings, which have changed throughout the 3 years. And of course, we're going to look at the performance. How well has this ETF performed? How well is it doing versus its competitors or some other similar all-in-one leveraged covered call ETFs? So let's check out this ETF again together, the one that started it all. Let's get going. All right, everyone, so let's start with the basics, the objectives of this ETF. Of course, it's right here on the website, on the homepage. I am on the homepage of the website here for HDIV. So if we look right away at the objectives of the fund seeks to provide attractive monthly income. Of course, it does. We'll look at that in a second, how much income. And long-term capital appreciation from a diversified multi-sector portfolio of primarily covered call ETFs. Keep that in mind. It says primarily covered call ETFs that are focused in Canada. So that says a lot really about this fund. If we look at, this is an ETF which is a good fit for what kind of investors? Well, investors that want attractive monthly income. This is important here. Sector diversification, broadly similar, but not identical, broadly similar to the S&P TSX 60 with higher yield. So we know that the TSX 60 or the S&P TSX 60, kind of like what the S&P 500 does for Canada, this for the US rather, this is 60 of the top or most important companies in Canada. So the TSX 60 is kind of like an index that pretty much gives you a broad base exposure to the Canadian stocks, or the top 60 Canadian stocks, which I believe make up the most or the vast majority of the entire Canadian stock market. So if we keep going here, increased growth potential versus individual covered call ETF. That's because of that leverage, right? If we look at the highlights of this fund, modest cash leverage of 25% to enhance yield and growth potential. So that's basically what the objective of this ETF is. It's pretty clear cut, everyone. So it's going to have a sector diversification that's similar to the TSX 60 or the overall Canadian market, which we'll see in a second. Obviously, attractive monthly income. This fund does have monthly distributions, and it has much higher yield than broad-based index ETFs like the TSX 60, for example, that has a yield of about 3%, whereas HDIV currently has a yield of approximately a little over 12%. So let's check out the composition now. So this is always the most important thing. Don't worry, we're going to check out performance in a second here. So if we scroll down to what this ETF holds, so this is an ETF that holds other ETFs. There are currently all other Hamilton ETFs as well. This is why you actually have the management fee. You see the management fee at 0. It's because fund managers can't charge double management fees on their ETFs, right? So this ETF has a bunch of other Hamilton ETFs, and of course HDIV will pay the fees of those ETFs. So that's why it says 0 here. But pretty much we could estimate or say, because all these ETFs or all the ETFs inside of HDIV has a management fee of 65 basis points, 0.65, you could pretty much say, or we could say, that HDIV's management fee is approximately 65 basis points. So this is the breakdown of what's actually inside of HDIV, and you'll see that the total is actually approximately 125%. That is because of the leverage. So this fund uses classic leverage. So they borrow 25% of the fund's net asset value. They borrow to invest more into this fund. So you're going to get 25% more exposure overall. That's why the total of all these ETFs, or the percentages, totals 125, approximately 125, not 100. So with 25% leverage, obviously you're going to get 25% more volatility, more risk, because you're getting 25% more exposure. But on the flip side, you are getting more yield, more growth potential over time. So that's fantastic as well. If you're a buy and hold, long-term buy and hold investor, I've said this before on my channel many times, if I have the choice, I would always go with a modestly leveraged version if there is one. And 25% leverage is not a lot. That's why it's, you know, they say it's modest leverage. It's basically like taking out a $250,000 mortgage on your home that's worth $1 million. So it's not, you know, it's fairly conservative. It's low risk leverage in my personal opinion. So now to understand really what's inside of HDIV, which is very important, right? We got to know what's inside this ETF, what you're really investing in, what are the stocks you're investing in. We have to look through these 9 ETFs in detail. So we'll do that really quickly. You could always look at them yourself on your own time for the details. But basically, here are the top positions of this ETF. So we'll go through them in order from the top positions in terms of percentages to the bottom ones here. So first of all, you have HFIN. So HFIN is actually not a covered call ETF. This is a enhanced or leverage, that's why you have enhanced in the name, Canadian financials ETFs that is an equal weight portfolio of Canada's 12 largest financial services companies. So this is going to have a lot of companies you'll recognize. It's going to have banks, it's going to have insurance companies, it's going to have asset managers as well, like Brookfield. So this is really some of the biggest blue chip financial companies in Canada. No covered calls here. So this is a pure growth ETF, actually an enhanced growth ETF, because there's 25% leverage. But this is not the norm. The fund is mostly made up of other covered call ETFs, just that this one is not. The next one is QMAX. So QMAX is the Hamilton Technology Yield Maximizer ETF. Whenever you see Yield Maximizer, that means it is one of Hamilton's covered call ETFs. If you look at our ETFs here, they have a bunch of Yield Maximizer ETFs. And all of these, or most of these rather, not all of them, most of these are in HDIV. So QMAX, you know, just like the name says, this is going to focus on 20 technology companies, mostly in the US, or exclusively in the US rather. So if you scroll down to what kind of stocks we're talking about, you have them here. Tesla, Apple, Nvidia, Google, Amazon, Netflix, Microsoft, AMD. So a nice mishmash of technology companies, software companies, chip makers, etc., etc. So this is going to be your technology covered call ETF, which makes up quite a big portion here, 19.4% on 125 of this ETF. The next one is HMAX. So HMAX is very similar to HFIN, except because it's Canadian financials as well, so it has a lot of the same stocks, but this is actually a covered call ETF. So this is a covered call Canadian financials ETF. You have the stocks here. Top stocks are going to be Royal Bank of Canada, NTD Bank, and Brookfield. So this one is not equal weighted. It's market cap weighted, which means the bigger companies will have the bigger percentages here. That's why you see Royal Bank, which is the biggest one, has the massive, massive percentage here. Very popular ETF, almost at $1 billion. You see here 840 million AUM. So this is pretty much, you could say, a covered call type of Canadian financials versus HFIN, which is more of a pure growth Canadian financials ETF. Moving on, the next one is EMAX. EMAX, which makes up quite a big chunk as well. And this is the Hamilton Energy Yield Maximizer ETF. So of course, HDIV is trying to track broadly similar to TSX 60, which is the overall Canadian market, which is very heavy on the financials and energy. That's why we saw quite a bit in financials and energy so far. But EMAX, what's interesting about it is that it's actually mostly US energy companies. There is some Canada as well. You see the breakdown here. But here are the stocks. So of course, there are Canadian companies that you'll recognize like Suncor and Canadian Natural, Tourmaline. But there's a lot of big US energy companies as well. Only the big boys, right? You have ExxonMobil, Phillips 66, Chevron, of course, etc., etc. So this is going to be your energy exposure, basically, which is a big part technically, or a big sector in the TSX 60. Next ETF is AMAX, which makes up, you see the percentage here, 15% on 123.6. This is going to be gold producers. This also is just like EMAX and HMAX, QMAX, all the maxes, right? A covered call ETF, which focuses on gold producers. So if you scroll down, you'll get the stocks, you'll get the names here. So you'll recognize a lot of these because they're all big. So you got Royal Gold, Barrick, of course, Newmont, Kinross, Franco-Nevada. So really the big precious metal producers, mostly in Canada. They're mostly Canadian companies, I believe. The reason why you see the majority or the big chunk in US is I believe that they're holding the US listed stocks. That's why. But a lot of these companies, I could be wrong here, but I think a lot of them are actually Canadian companies. Next on the list is UMAX. So UMAX, 11.9% on 125 approximately here. So UMAX is utilities, right? So this is going to be purely Canadian utilities. So unlike EMAX, which is mostly US energy companies with some Canada, UMAX is going to be pure Canadian exposure, Canadian utilities. You'll recognize a lot of the companies. So this is going to have telecom, pipeline, utility companies. So you have things like Rogers and Telus and Bell for your telecom. You have some pipelines like Enbridge, Pembina, and you have TC Energy as well. And you have some infrastructure like Brookfield Infrastructure and electricity companies, right? Like Emera, Fortis, etc., etc. So, more or less a more defensive, stable sector in UMAX, and again, a covered call ETF here. Next, we have LMAX. So LMAX is interesting because it's healthcare. So you have about 10% on 123, which makes it about 8% or so of the fund in healthcare companies, which are pretty much non-existent in Canada. So if you scroll down and look at the stocks, these are mostly all US-based companies here, right? So you have Pfizer, you have AbbVie, Johnson & Johnson, Eli Lilly. You'll recognize a lot of them. It's also diversified within the healthcare sector. So you have medical equipment companies as well as pharmaceuticals, insurance companies like United Health Group, of course, which is big. So I thought this was a very interesting choice. I kind of like it that they put it in HDIV, even though it's following more or less the TSX 60 sector, because there's basically nothing. There's no healthcare. There's not much in Canada. So this is a great thing that they did here, in my opinion. Next, more of the smaller positions, you have HUTS. So HUTS is the Hamilton Enhanced Utilities ETF, and just like HFIN, it is not a covered call ETF, but HUTS basically, I would say, complements or has the same type of exposure as UMAX utilities company. So Canadian utilities companies, again, this is a leveraged ETF as well, just like HFIN. So it's going to have 12 very popular, Canadian utilities companies. So I find that interesting because what you have is you have a little bit of growth and you have the covered call version or the income version in the Canadian utility sector. Same thing for Canadian financials, right? You have HMAX to get your covered call exposure, to get your more income exposure, but then you have HFIN, which is, similar stocks, but to give you your pure growth exposure. Last but not least, the newest ETF they added is actually the newest yield maximizer or covered call ETF that Hamilton came out with. The first or only, it's not the first, but the only covered call REIT ETF currently in Canada, which focuses on North American REIT. So there's a few other ones, but RMAX is really the only covered call REIT ETF that focuses on North American REITs. So here it is, it's RMAX, and it really has a 50-50 mix of Canadian REITs and US REITs. You have them here. Again, only the big cap blue chip REITs. So that is currently the smallest position in HDIV. So that is the current composition of HDIV currently. And I actually did the calculations for you guys last night. So because it's not a pure income focused ETF, because like we saw, HFIN and HUTS, they're not covered call ETFs, the rest of them are. It's actually, this ETF, you could say, is approximately 78% income oriented, or 78% of its exposure is in covered call ETFs, and about 22%, approximately 22%, is in growth. So this is the first thing that makes this ETF very unique, everyone. It's not a pure income ETF, although that the majority is, and this is really why it says primarily covered call ETF. So you have HFIN and HUTS that gives you a little bit of growth in this portfolio. So about 22% growth, but the majority 78% income oriented. And even in terms of geographic, we know it says here it's broadly similar to the TSX 60, which is a Canadian index. But again, I did the calculation because thinking of QMAX, which pretty much all has US technology companies. You have EMAX, which has a lot of, or mostly US energy companies, LMAX, RMAX. So I did the calculation because there is some US exposure here. This ETF is about approximately 68% Canadian exposure, so definitely the majority, but a nice chunk, 32%, in US exposure. And we know that the US market, especially the technology sector, is very, very important to have. It's, technology and healthcare are really the two sectors, in my opinion, that are really underrepresented in Canada. Canada is more of a natural resource-based economy, so there's a lot of energy and gold producers and financials as well, and it is present here, right, with AMAX, EMAX, HFIN, and HMAX, but it's really lacking healthcare and technology. So I really like the fact that they added the QMAX and the LMAX to add that level of diversification to make this fund kind of a hybrid between Canada and US, but the majority, the focus, 68% approximately, is focused in Canada. So that is the current composition of the fund. I just wanted to show you something which I find interesting, because HDIV's composition has changed throughout the year. So when it first came out, I'd like to thank Hamilton for sending me this. I had trouble finding it. But when HDIV first came out in July of 2021, this is what it looked like. It actually held all external or third-party ETFs. So it had ZWB, which is the BMO, which I believe still is the biggest covered call ETF in Canada in terms of AUM. It's the 6 Canadian banks. So for its Canadian financials, it held ZWB. For life insurance, it held FLI from CI. It had ZWU also from BMO for the utilities. It had HHL, of course, very popular, big healthcare covered call ETF from Harvest. The HTA, the Harvest Technology, NXF, Energy, the CI ETF, so et cetera, and GLCC from Horizons, which is now Global X Canada for the precious metal exposure. So why all the changes? Well, it's very, very simple, guys, because back in the day, Hamilton did not have any of their yield maximizer ETFs like they do now. So throughout the years, and we actually have the timeline here, which is pretty cool. When their ETFs started coming out, they started basically removing the third-party ETFs and adding their own in-house ETFs, which now translates to a fully in-house product. And that's why, like I discussed with them in a previous Q&A, you see the management fee of 0. So this is extremely beneficial for investors because we don't have to pay double management fee, right? Because with HDIV, when it first came out in 2021, HDIV was paying the management fees to all these managers, plus HDIV was charging a 65 basis point management fee. Now, because they're all in-house Hamilton ETFs, you basically save pretty much half the management fee, right? So this is really, really good news, and I just wanted to share the evolution of the composition of HDIV because it has changed over the years, like we saw on that chart. And I feel like it's a really, really nice, solid composition now. It's a nice, solid mix of between income and growth, but Canada and the US as well. So it's a very, very unique fund in that way. And it's been performing really well. Speaking of, now it's time to look at the distributions, the yield, and of course, the performance. So let's talk about the distribution history and the current yield of this ETF. So if you scroll down, everyone, click on distributions, you have the whole history here. And as you could see, the distributions not only have they never missed a distribution, but they've only increased over time. So they start at 11.75 cents a month. They increase it to 12.5. Keep going, 13.5, 14, 14.1, 15.1, 16.5, 17.1. So they've only increased it. Of course, this is supported by all the changes they did by bringing this in-house. Obviously, that helps the distribution sustainability, right? And of course, this fund is doing really well. So the current monthly distribution is, for the last 3 months, is 17.1 cents. So Hamilton, I've discussed this with them at length. Their distribution policy is they actually hold back approximately 1% of the income that comes into this ETF as a cushion. So this is a very conservative distribution system, whereas they're not even giving out all the income this ETF is making or all the income the ETFs inside this fund are generating. They're actually holding it back just in case as a cushion. So this is a very conservative strategy. And I've discussed this at length with them. And by the way, I'll put the more recent Q&As in the video description below, where I actually talked to the main guys at Hamilton about this. But the current distribution is 17.1 cents a month. If you multiply that by 12, you get $2, just over $2.05. So if we figure out what the current yield is on the day I'm filming this right now, HDIV is $16.35. Of course, it's going to change by the time this video comes out. But if the distribution is the same, all you have to do is this number, 2.052, divided by the stock price, the current stock price, and you will get the current, multiply that of 100, by the way, and you'll get the current yield if you buy HDIV at 16.35. You would get a really super nice solid yield or annual distribution rate of 12.55%. So really, really, really nice yield here, everyone. Very solid distribution history, only increase over time, which a lot of the changes that it's made has helped to support that. Again, check out those Q&As where we discuss that in detail. So phenomenal distribution history. What about the performance? What about the performance? So, of course, the easiest thing or the thing that makes the most sense to compare it to is the actual TSX 60 index, because although it's not identical, it's the sectors are similar. And as you can see from this chart, HDIV is easily beating the TSX 60. When we think of the TSX 60, guys, it's basically the ETF that we should all think about and know about is XIU. So XIU is the BlackRock S&P TSX 60 Index ETF, very popular ETF, by the way. It says here it's actually the first ETF in the world that came out in 1990. So the TSX 60 or XIU basically tracks the overall Canadian market, which is very focused on energy, precious metals, of course, or materials, and the biggest one, financials, right? If you look at the holdings, you will see that, Royal Bank, the top stock, Toronto Dominion, basically all holdings here. You could see all the stocks, but it's basically Canada's, top 60 most important stocks. And of course, the more important or the bigger the company is, the bigger the weight will have. So it's not exactly the TS 60, but it's similar. And if we just do a performance chart, I mean, I know they have it here on the chart, they have it here on the website, but if we actually use the Canada Stock Channel and we compare it to a few ETFs, so the first one we're going to do is XIU, so you can actually see that the total returns here is much better with HDIV. Total return since inception, and what I like about this website is that it will use the proper or the same start dates and end dates to compare. Remember, when you're comparing an ETF, everyone, you got to use the same start date and end date. So it's going to take use the start date of the ETF that came out the latest, which of course is HDIV, right? So it came out in, you see here, July 21st, 2021. So if you would have put 10 grand in HDIV and 10 grand in XIU, you would have 13,300 with HDIV and only 12,173 with XIU. So HDIV has consistently, you could even see it in the chart here, consistently outperformed XIU by quite a big margin. But you might be saying, yeah, but XIU is not leveraged and HDIV does use 25% leverage. So there is an ETF, there's actually it's by Global X Canada, it's called CanL. So this is actually an ETF that's the TSX 60 or XIU with 25% leverage. It's actually enhanced, right? So if you look at the holdings, it's 125% of the TSX 60. So how does HDIV compare to that, right? Which has been out for over a year. And you could see that HDIV is even outperforming CanL as of today. Of course, this is performance. We don't know what's going to happen in the future, what the performance is going to be. But HDIV, I just wanted to show you this because I found this very interesting. Because HDIV, yes, does have 25% leverage, XIU does not, but CanL does, and it's basically XIU with 25% leverage, and you see that HDIV is also outperforming CanL, which is incredible. And I personally, my opinion here, I credit that to the composition, to the fact that it does have some US exposure, which, as we know, typically the US market does outperform the Canadian market over time. So obviously the guys at Hamilton know what they're doing. They picked the right sectors here, great composition. But what about other leveraged all-in-one style ETFs? Well, we could compare it to a few others that are leveraged here. So one competitor is BMAX. This is Brompton's leveraged all-in-one. They actually use 33% leverage. It's not full equity, however. There is some fixed income in here. But anyway, if we do the comparison with BMAX, you'll see that HDIV is outperforming BMAX as well. Not by much, but it is still outperforming. So again, very, very competitive. I find this interesting because BMAX does have a lot of US exposure. So you see that HDIV is outperforming BMAX as well. Another competitor is HDIF. This is Harvest's leveraged all-in-one covered call ETF. If we do a comparison with HDIF, which by the way came out very close at the same time as HDIV, you see that HDIV is outperforming HDIF as well by quite a bit here. So That's it, everyone. We covered the performance, which is obviously exceptional, the consistent distribution history, which also has been exceptional, no misses, only increases over time, very conservative with a 1% cushion. Again, if you want to learn more about that, I'll put the links to the past Q&As, which I feel you should watch if you're interested in this fund, in the video description below. So another thing I want to point out is that Hamilton did release this article August 8th, so it's very recent. They're doing basically quite a summary of you know, how HDIV is doing, and they've also have this interesting, very interesting graph here. You know, they compare HDIV composition to the TSX 60. What are the differences? We kind of covered that in this video. They talk about the benefits of 25% leverage. Another important thing to look at is they actually simulate a $100,000 investment, and after approximately 3 years, or after 3 years, what happens if you drip or you don't drip. So if you dripped it, so if you reinvested all those dividends, your $100,000 will have become $145,000 after 3 years. If you don't drip it, which means you just take the distributions as cash, you actually have 107. The capital went up a little bit, 100 to 107, but you would have $31,000 of income. So 107 plus 31 is 138,000, right? So yeah, I'm not really good with math, but that's pretty much it. So 138,000, your 100,000 would have basically became 138,000 if you didn't use a drip, if you lived off the income or whatever you choose to do with that income. But if you would have chosen to drip, you would have had 145. So that just shows you the power, as well as compounding and automatic dollar cost averaging. That's what the drip does. So this is a great fund to drip. So maybe you're not retired yet. Maybe you're still building up to retirement. This is a fantastic fund. We see that it holds really strong against growth investments, or it's actually outperforming a few growth investments that we saw, indexes. This is a great fund to hold in your retirement, hold in your TFSA, put the drip on, and let it compound over time. You're obviously going to be very, very well off in the future. So I also suggest you guys check out this article. It's really well written, well thought out, and that is my my overview of HDIV after 3 years. So again, happy anniversary to HDIV. This is a very special ETF that will always be special to me, because it really started, or kicked off, was the first of its kind of what I feel is my personal favorite type of ETF, a diversified all-in-one covered call ETF with 25% leverage that really helps over time, with high yield. So this one has it all. It's very, very unique, again, because it has US and Canadian exposure. It has growth and income exposure, solid distribution, solid performance. What more can you ask for? So I highly recommend, if you haven't considered this or don't own this already, to really think about it. If you have any questions, let me know in the comment section below, and see you next time.